What if I told you that a paid-off, mortgage-free house, the ultimate American dream,
Right.
the thing we literally all work decades to achieve, right? What if that might actually be the exact thing that bankrupts a fixed-income retirement?
It's a scary thought. It really is.
It is. Because we are so conditioned, from birth, basically,
Yeah.
to view home ownership as the finish line of financial security.
Yeah,
You
absolutely.
pay off the bank, you finally get the deed, and you're supposedly safe.
Yeah.
But today, we're taking a deep dive into the really murky math of home equity. And we're looking at a very specific, but honestly incredibly common demographic.
Right.
We're talking about retirees who are living solely on Social Security.
And it's a massive demographic. I mean, it really creates this fascinating paradox,
Yeah.
because you have millions of people who are essentially, well, they're income poor, but asset rich.
Asset rich.
Yeah.
Okay.
They might have, say, $500,000 in equity just locked up in the wood and bricks of their home.
Wow. Yeah.
But maybe only $2,000 a month coming in from the government to, actually buy groceries, keep the lights on.
And the mission of our deep dive today, what we're really trying to do here, is to shatter this incredibly pervasive misconception that tapping into that home equity is just like a harmless safety net.
Mm-hmm.
We're unpacking the hidden mechanics of real estate debt. Because whether you're looking ahead to your own retirement or, maybe you're sitting at the kitchen table trying to help your aging parents untangle their finances.
Which so many people are doing right now.
Exactly. Understanding how this specific type of debt behaves is, it's an absolute masterclass in risk management.
The stakes could not be higher. We are talking about combining someone's primary shelter with an income stream that has zero elasticity.
Right.
Social Security does not stretch.
No, it does.
It cannot absorb a major financial miscalculation.
Okay, let's unpack this. Because I think the biggest mistake in this scenario is really a foundational misunderstanding of what equity actually is.
Yeah.
People treat the value of their home like an emergency fund.
Yes, exactly.
They look at the house like it's a giant ATM sitting in the front yard.
Right.
But they are completely ignoring the exorbitant withdrawal fees attached to that machine.
And calling it an ATM is the perfect trap.
Really?
Yeah, because think about it. An ATM dispenses your own money.
True.
But home equity is not your money in a liquid, accessible sense. It's collateral.
Okay.
When you access it, you're taking out a loan. You are literally borrowing your own wealth back from a bank.
Wow.
And that bank is charging you a hefty premium for the privilege of accessing it.
Let's break down the reality of those premiums. Because when you say loan, I think a lot of people's brains, they're still anchored to those incredibly low mortgage rates we saw just a few years ago.
Oh, yeah. The 3 or 4% days.
Right. 3%, maybe 4% if your credit wasn't great. But that is not the reality of tapping equity today, is it?
Not even close. In today's economic environment, borrowing against your equity is expensive. We're looking at annual interest rates hovering between 8 and 12% for these types of financial products.
8 to 12%.
Yeah, 8 to 12.
Man. Okay, let's ground that in cold, hard math.
Yeah.
Because if a retiree decides to take out, let's say, a $100,000 home equity loan,
Okay.
because maybe they need to put on a new roof, or they have lingering medical bills, or, a massive property tax assessment.
Happens all the time.
Right. So they take out $100,000. They are signing up for $8,000 to $12,000 in yearly interest.
Exactly.
Just the interest.
Just the interest alone. And, that money has to materialize from somewhere.
Right.
If they don't have a robust 401k or a private pension to draw from, that $10,000 is being carved directly out of their Social Security. And when you consider the median Social Security check, you're talking about wiping out nearly half of a person's annual survival income just to service the cost of accessing their own equity.
Just to pay the interest.
Just the interest.
I have to push back on this, though.
Yeah.
Because, we live in a highly regulated financial system.
Sure.
Banks have entire risk management departments,
Yeah.
right? Don't lenders set safe limits to protect borrowers from exactly this kind of disaster?
You would think so.
A bank isn't going to underwrite a loan for someone who objectively cannot afford the monthly payment. They have debt-to-income ratios. They have stress tests.
Right. But what's fascinating here is how fundamentally flawed standard underwriting algorithms are when they're applied to a fixed income retiree.
How so?
Well, those algorithms calculate your debt-to-income ratio based on the assumption of upward income elasticity.
Oh, meaning they assume you can always get a raise,
Exactly.
or work overtime, or switch jobs if inflation hits.
Right, which is exactly the opposite of a retiree's reality. A 75-year-old living solely on Social Security has zero upward income elasticity.
Yeah, that makes sense.
Their income is flat, save for minimal cost of living adjustments that rarely keep pace with real-world inflation.
Right, the CLA adjustments never seem to cover the actual grocery bill going up.
Never. So when a bank's algorithm says a retiree has a quote-unquote safe buffer of $300 a month,
Yeah.
that buffer is a mirage. If property taxes spike or utility rates jump, that buffer vanishes instantly. And the standard algorithmic safety net completely fails the borrower.
So the bank basically stamps approved on the paperwork,
Yep.
and the retiree naturally thinks, oh, I'm making a safe, federally regulated decision here.
Exactly. But behind the scenes, the actual margin for error is zero.
Wow.
Which brings us to a really critical insider rule of thumb that's used by seasoned mortgage brokers.
Okay.
And this actually contradicts that basic approval logic. The internal guidance they use is to never tap more than 20% of your home's equity.
Never more than 20%.
Right. But the crucial caveat, and this is the part that gets glossed over constantly,
Yeah.
is that you should only ever borrow that 20% if the debt can be serviced entirely from non-Social Security income.
Wait, really? Let me underline that.
Yeah.
So the rule isn't just keep your borrowing small.
No.
The rule is you must pay for that borrowing using money that is not your government safety net.
Exactly.
If your only income is Social Security, adding a new debt service threatens your structural stability in a way that the bank's computers simply aren't programmed to care about.
The math simply does not support it. It just doesn't.
Man. So if the underlying mechanics of this debt are so structurally dangerous, we really have to look at how people end up backed into this corner.
Right.
Because nobody wakes up on a Tuesday and excitedly decides to put their long-term stability at risk.
No, of course not. And it rarely happens overnight. The need to tap equity is a gradual, creeping squeeze.
A creeping squeeze.
Yeah, it occurs when that fixed, inelastic income slowly starts covering the escalating costs of simply existing in the house.
You know, it reminds me of taking out a high-interest payday loan just to pay the cover charge for a club you're already standing inside.
Oh, that's a great analogy. Yeah.
You're paying a premium just to maintain your current baseline. The house itself becomes the financial burden.
Right.
We always think of a loan as the solution to an affordability problem. But affordability does not magically end just because you got the loan approved.
No. Borrowing against a home does not freeze its ongoing operating costs.
Oh, wow. Yeah.
Your property taxes are still going to be reassessed upward.
Right?
Your homeowner's insurance premiums, which are skyrocketing nationwide right now, those keep going up.
Yeah, they really are.
Your healthcare copays are increasing.
So if we connect this to the bigger picture, you are essentially stacking a really expensive fixed loan payment directly on top of the very variable pressure points that forced you to borrow in the first place.
Exactly. And we haven't even factored in the physical decay of the asset itself.
Yeah, if I was falling apart.
Yeah. There is a brutal maintenance metric that every single homeowner needs to budget for, which is that projected maintenance costs run 1 to 2% of the home's total value every single year.
Every year.
Every single year.
Okay, let's do that math. You own a $400,000 home.
Okay.
That means you need $4,000 to $8,000 in liquid cash annually just to fight entropy.
Right.
You know, the roof ages, the foundation shifts, the HVAC system just randomly dies in July.
Yep.
That 1 to 2%, it isn't a suggestion. It's practically a law of physics.
It really is. And when you defer that maintenance because your Social Security check simply can't cover it, the home actively loses value.
Wow. So you are bleeding equity from the top
Yeah.
through a high-interest loan.
Yes.
And bleeding value from the bottom through physical decay.
Exactly. So those total carrying costs,
Right.
right? The taxes, the insurance, the unavoidable maintenance,
Oh, yeah.
those have to be calculated before you even look at a loan application. If your monthly check cannot handle those carrying costs, borrowing money isn't going to save the house.
It's just going to accelerate the timeline of you losing it.
It is a mathematical death spiral.
A death spiral.
Oh,
Okay.
yeah.
Well, let's assume someone is already in that squeeze.
Okay.
You know, the water's rising, they desperately need cash for medical emergency, and they have to use their house.
Right.
If we recognize that some people are just forced to use these tools, we need to dissect the actual mechanisms available to them, because the structure of the debt dictates how fast that death spiral spins. Yeah.
Absolutely. And for the specific demographic,
Yeah.
again, the income poor but asset rich,
Yeah.
the structure of the loan matters significantly more than the interest rate.
See, here's where it gets really interesting to me. Because my instinct, and I assume the instinct of literally anyone trying to be financially responsible,
Sure.
is to shop for the absolute lowest interest rate. Right. And a cash-out refinance traditionally offers a much better rate than a personal loan or a credit card.
True.
So I would naturally assume a cash-out refinance is the smartest, safest move. Why is that considered rarely appropriate for someone relying only on Social Security?
It comes back to how the product is structured. A cash-out refinance essentially wipes away your old mortgage and restarts the clock with a brand new, larger loan.
Oh.
You're extending your debt timeline, often resetting it for another 15 or 30 years.
Wow, yeah.
But the structural flaw is that it requires qualification income to support a new, larger monthly payment.
And as we just established, Social Security does not provide the monthly cash flow to satisfy those underwriting demands.
Exactly. The numbers simply won't clear the hurdle.
Yep.
They don't have the monthly liquidity to support a newly supersized mortgage payment.
Okay, that makes total sense.
Yeah.
So that knocks the cash-out refinance off the table entirely.
Right.
What about a HELOC, a home equity line of credit?
Right, a HELOC. Well, a HELOC functions essentially like a massive credit card secured by your living room.
Right.
You draw down the cash as you need it, but the moment you do, you are on the hook for monthly payments, and usually at a variable interest rate that can adjust upward.
Oh, a variable rate.
Yeah. And adding a new mandatory fluctuating monthly payment to a fixed income is the exact trap we just warned against.
Yeah, it drains the monthly cash flow even faster.
Exactly.
Okay, so if the cash-out refi and the HELOC are structurally toxic for a fixed income, what is left? I mean, I know reverse mortgages get brought up here, but I have to be honest, they carry a massive amount of cultural stigma.
They really do.
They feel like, I don't know, a late-night infomercial scam.
Yeah, with an old celebrity telling you it's free money.
Right, exactly. But I'm trying to square this logically, because if draining monthly cash flow is the enemy,
Yes,
a reverse mortgage actually lets you skip the monthly payment entirely.
it does.
So what is the catch? Because there is no way the bank is just letting you live there for free.
Right. Well, the stigma is largely rooted in how these products were wildly unregulated decades ago. They are highly structured now.
Good.
And for households strictly dependent on Social Security, specifically retirees ages 65 and older, a reverse mortgage is actually considered a viable alternative, precisely because it eliminates the monthly payment requirement.
Right, but explain the invisible mechanics of that for me. How does the bank make its money if I'm not writing them a check every month?
They make it through a mechanism called negative amortization.
Negative amortization.
Okay,
How does that work?
So you're borrowing against the equity, and the interest on that loan is still accumulating every single month.
Okay.
But instead of you paying it out of pocket, the bank simply tacks that interest onto the total balance of your loan.
Oh, wow.
Yeah. And then the next month, you are charged interest on the original loan amount plus the previous month's interest.
Oh, I see. So it compounds.
Yes.
So the debt is just compounding in the background.
Yes.
Literally silently devouring the remaining equity while you sleep.
Precisely. You preserve your Social Security check for groceries and medication today, but you are systematically draining the generational wealth of the home.
So when do you actually pay it back?
The loan, plus all that compounded interest, is eventually repaid when you sell the home or move out for medical care or pass away.
Wow. Okay, so when's the trade-off? You're buying monthly survival by sacrificing the back-end equity.
Exactly.
But even with a tool like a reverse mortgage that, fits the fixed income structure a bit better, adding any debt to a primary residence is basically playing with fire.
It really is.
If every borrowing tool has a structural flaw that either drains your monthly cash or silently devours your equity in the background, we kind of have to rethink the entire approach here.
We do.
Because it sounds like you don't need a better loan. You need to eliminate the carrying costs entirely.
Yes. Which points to, really, the only mathematically sound consensus among financial experts for this specific scenario.
Which is?
Downsizing. Downsizing is considered a far more rational, structurally secure option than borrowing against the home.
So selling the big house and moving to a smaller one.
Yeah. The mechanics are straightforward, but they solve the root of the crisis.
How so?
Well, you sell the current home outright, you take the accumulated equity, and you use it to purchase a lower-cost property completely free and clear.
Ah.
No mortgage, no HELOC, no reverse mortgage compounding in the shadows.
So, practically speaking, what does this actually mean for the daily reality of the retiree?
It creates an immediate, permanent reset of their financial baseline.
Okay.
First, if they buy the new property for significantly less than they sold the old one, they walk away with a cushion of liquid cash in the bank.
Which is their new emergency fund.
Exactly.
Yeah.
And more importantly, they permanently slash their carrying costs.
Right, because a smaller, less expensive home means radically lower property taxes,
Yep.
cheaper insurance premiums,
Oh, yeah.
and a massive reduction in that 1 to 2% annual maintenance burden we talked about.
Exactly. So you aren't just treating the symptom of needing cash. You're
Yeah.
actually curing the underlying disease, which was that the house was simply too expensive for the Social Security check to support.
You literally shrink the footprint of your liabilities to fit the reality of your income.
That's beautifully put, yes.
There is a massive psychological and strategic hurdle here, though, isn't there?
Oh, absolutely.
I mean, selling the family home where you raised your kids,
It's emotional.
it's brutal. But the timing of this move really dictates whether it's a victory or a tragedy.
Timing is the defining factor. Downsizing only works if you execute the strategy before it feels urgent.
Oh, man. So you have to move before the math forces you to.
You have to pull the trigger while you still possess enough equity to make the math work.
Right.
Because if you wait until you've already drained 50% of your equity through high-interest loans, or, you've deferred so much maintenance that the house won't even pass an inspection without a massive price cut,
That won't happen.
you lose your leverage.
Yeah.
You might sell the house and find that you don't actually have enough cash left over to buy a new place free and clear.
Which means you are forced right back into the rental market or taking on a new mortgage in your 80s.
Exactly.
Making that choice early, looking at the trajectory of your expenses and making that hard call, it actually preserves your autonomy.
It does. You get to control the sale rather than the bank or the tax assessor controlling it for you.
Yeah.
And failing to clear that emotional hurdle leads to really the most dangerous territory a retiree can enter.
Okay, what is that?
Well, there is an undeniable red flag that signals you have totally lost control of the math.
What's the absolute warning sign that you are in the danger zone?
It's borrowing against your equity simply to cover the everyday carrying costs of the home itself.
Oh, wow.
Yeah. If you are taking out a home equity loan or drawing on a HELOC specifically to pay your annual property tax bill or to renew your homeowner's insurance,
Yeah.
the stark mathematical reality is that you no longer own the home. The home owns you.
Man, that is heavy.
It is.
But it's structurally true. I mean, if you have to go into debt just to maintain the legal right to keep the shelter over your head, you're just funding a sinking ship.
You are.
You're delaying the inevitable at a massive interest rate.
Because it represents a fundamental, irreconcilable mismatch between your fixed income and your liabilities.
Yeah.
For a retiree relying solely on Social Security, home equity must be treated strictly as a last resort financial tool, never as a supplementary income stream to fund daily living.
We spend our whole lives viewing a paid-off house as this, ultimate financial fortress.
Right.
It's supposed to mean you are safe from landlords and rent hikes.
Yeah.
But if you start hacking away at the walls of that fortress just to pay for groceries or taxes, you are destroying your own shelter.
There is a brilliant summation from our analysis that encapsulates this perfectly.
Oh, yeah.
The quote states, "The home is your last financial bastion. Once you breach that with debt, it becomes much more difficult to repair."
The last financial bastion.
Yeah.
Because if you knock a hole in that final wall of defense by taking on 8 to 12% debt that you cannot service, the elements just rush in.
They do.
And rebuilding a breached wall when your only mortar is a fixed Social Security check, I mean, it's virtually impossible.
It is the ultimate cautionary tale of asset management.
Really is. Before we close the book on this,
Yeah.
we definitely do need to include a vital piece of context here for everybody listening.
Yes, absolutely.
The mechanics and the strategies we're unpacking today, they are for informational purposes. We're analyzing the math of equity debt, but applying these moves involves very real, very individualized risks.
Right.
So anyone navigating these waters needs to consult with a qualified financial advisor who can actually run the specific algorithms on their unique numbers.
Exactly. The structural rules apply broadly, but the execution requires deeply personalized professional analysis.
So we have navigated some incredibly murky waters today. We shattered the ATM illusion. We exposed the 8 to 12% reality of equity debt. We uncovered why standard banking algorithms totally fail fixed-income retirees, and why a newly added debt payment basically creates a debt spiral when it's stacked on top of rising property taxes and that unavoidable 1 to 2% physical maintenance rule.
And we analyzed why the structure of a loan is far more critical than the interest rate,
Right.
making cash-out refinances structurally toxic and reverse mortgages a tool of extreme calculated caution due to that negative amortization.
And we laid out the mathematical consensus that downsizing early, eliminating the carrying costs entirely before desperation actually sets in, is the ultimate power move to protect that last financial bastion.
It really is. But, this raises a really important question.
What's that?
Well, the entire architecture of the safety net, right? The ability to downsize, the luxury of having a financial bastion to protect. It all relies fundamentally on the assumption that the retiree was actually able to purchase and pay off a home in the first place.
Right. It assumes you have the asset to begin with.
Exactly. So if the ultimate financial safety net for a fixed-income retiree relies entirely on having a home to either downsize or carefully borrow against, what does the future of retirement look like for the rapidly growing generation of lifelong renters?
Oh.
The people who will enter their fixed-income years having never acquired a last financial bastion to fall back on.
We'll leave you to ponder that. Until next time, keep diving deep.